When we look at the budgeting part, and that comes into the corporate finance of the CFA level 2, uh, it brings into picture many interesting things. Now, first and foremost part here is that I understand that this is one of the most numeric centric part, but the question types are limited, so don't worry about that. So whenever you buy something, the money that you are going to pay for that is the money that you are investing in. What that would bring into you is some benefit or some increased sales, or that would reduce your cost and would benefit you in some way. But to analyze the questions of the budgeting where you buy something, you need to understand a few play that would happen. So the first play, or at the initiation, you will pay the price and you will pay the working capital or the new assets that you have to create. Now this working capital could be in terms of you need more inventory or you need more cash or whatever, but whatever that is, it would be a cash movement. So whenever you buy something, the money that you are going to invest is the price of the thing that you are buying plus the working capital. So working capital incorporates a lot of things which you might be given in a redundant way for the exam, so don't worry about that. If you are taking change in working capital, you have already taken care of the cash, the additional inventory that you need, so don't get in the trap, don't double count things. Now when that is over, the thing that we need to understand now is to understand what is the cash benefit that we are going to get. So the cash benefit that we are going to get could be an extra sale or could be saving in terms of some cost. So these are the two cash benefit, but again we'll get one more thing, that is that benefit is the depreciation benefit. So the depreciation benefit that we would get would act as a cash component to us. So we'll show some depreciation, and that depreciation would save us some tax, and that depreciation would is something that we need to add back, because that is a cash that is not spent anywhere. So that depreciation contributes in the cash. The cash that is saved at the sales or the COGS is again a cash. So those are the two cash expenses. And after, at the end, when you sell the thing, then the cash that you get is the entire cash and not the book value minus the selling value. So the cash that you get is the entire cash, and the working capital change is again a cash benefit to you, where you won't be needing that working capital. So that's the three stage or three cycle of the budgeting aspect, where you have initiation, you have the interim cash flow, you have the final cash flow. The few thing that is important here is that you will focus on cash and how things would change. You will get a depreciation shield when you buy something. You have to make sure you account that as well. Okay, the next part here is the economic value added or the economic cost. So whenever you see this term, you have to remove the WACC or the cost of equity. So economic value added is something added beyond your cost of equity, because cost of equity is something that some or the other person is expecting from you. And the last and the small part that you should be careful about is that you can use multiple, and you can multiply with 2.5 where you want to repeat some project. So if you want to repeat some project, if you want to compare some project of an equal size, you can go ahead and multiply it with fractions. So that was in very brief about the budgeting section of the CorpFin part of the CFA level 2 exam. I hope this was a little insightful. Thank you for listening.